We had stocks selling off today as some states report a record jump in the number of coronavirus cases. So here to help us make sense of what the markets think about all this, we have Jason Draho. He's head of Americas Asset Allocation for UBS Wealth Management. And Jason, let's just start with the sell-off that we saw today. Obviously, coronavirus, a huge concern here amongst investors. What do you make of today's big decline?
So I think, in the previous conversation, there's a talk about potential tipping points. We've seen the case counts rise, in the past couple of weeks. I think what's kind of the catalyst today that caused spooked investors a little bit more was talk about sort of hospitalization capacity. Because I think that's the key kind of metric. It's not so much the number of cases, but what's sort of the demand and the pressure being applied to the healthcare system. That's what we saw back in March and April, why we had kind of shutdowns and lockdowns in New York State and elsewhere. As we see in some of the states such as Arizona, Texas, California, Florida, looking at sort of the number of ICU beds in terms of spare capacity, we're probably sort of 2 to 4 weeks away. And given the rate of kind of growth in those states and the number of cases, the concern would be, does that start to become constrained? And if that's the case, then you have a situation where policymakers have to maybe start to impose lockdowns. It could be local, it could be statewide. But once you have that, well, then you have the negative impact on growth. And so if you look at the markets today, I think it was the first time that you start to really think, well, perhaps we could get some further lockdowns, which seemed like a lower risk before. And if you look at the sort of the sector performance across the markets today, everything that's more cyclical oriented, energies, industrials, financials, which had done well, those sold off, all kind of consistent with the idea that maybe this recovery won't be as fast as we expect. And I think that's the market reaction today.
Andy, you're muted.
Sorry about that. That's the shorter term, Jason. And listening to you and Miles Udland, both of you guys, I mean, you sound like medical experts, but that's what it takes now to really understand what's going on in the markets and where things are going. And, I think that's certainly something you have to, obviously be on top of these days. But my question is, when you're talking to your clients at this point, how do you lay things out, say, for the balance of the year? And, maybe even going into 2021 at this point?
So, what we're sort of think about the overall macro environment. And what we've seen is a faster economic recovery and sort of faster normalization of economic activity, not just the US, but we're also seeing it in Europe. Some of the data that's come out in the past 2 days in Europe in terms of manufacturing, in terms of sentiment, have all shown significant improvements. We're seeing that elsewhere in the world. So we're seeing a kind of a fast recovery. We know we have central banks that are providing almost unlimited support. That's clearly been a tailwind for the markets. That certainly won't change. It's unlikely to change for the time being. And therefore, given those factors, the fundamentals still sort of suggest that this is a reasonably supportive environment for risk assets. So we still think investors should be invested. They shouldn't be taking chips off the table. And in fact, things like today, like days like today when the market's reacting to the virus news, this is sort of what we should expect. We're going to get days of volatility, pullbacks of 2-3%. We had a pullback just a couple of weeks ago of almost 6% in one day, and it was about 8% over the course of a few days, and then we kind of bounced back. So we think, and what we're having advised our clients is that when you get days like this, if you're looking to put money to work, and there are people who've kind of sold off in March, they've been waiting for an opportunity. We think there's still a chance to be able to put money to work. I think being selective and looking at areas where maybe have underperformed. So as we get sort of a rotation in the markets, things that have been lagged a little bit more, like sort of mid-cap equities, that's one of our preferences. Do things like that. It's also the case in kind of thinking about why the market's pulled back a little bit. There's been a lot of discussion, and there will be for the next few days, about sort of quarter end rebalancing, certainly for big institutional investors and pension funds. We have to keep in mind that this quarter will be one of the best quarters ever for the S&P 500. So if you were fully invested, maybe you need to rebalance and think about actually kind of getting back a little bit to your benchmark. So it really depends on the context. Some people should be maybe adding exposure. Others perhaps want to dial back a little bit, given how much the markets performed, and they're perhaps over what they should be allocated to.
Hey, Jason, Rick Newman here. So the market seems to be focused on states perhaps reimposing lockdowns, but there's another thing going on, which is consumers just voluntarily locking themselves down. I mean, they just don't necessarily want to go out when they hear about increasing caseloads wherever they happen to live. How do you take account of that? How do you measure that? I mean, that does show up in lagging numbers like retail sales, but how does the market take a better measure of that in real time?
So I think what we've learned over the past few months is that consumers, they're consumers, they want to spend. We saw that back even in April and early May before the lockdown measures lifted. There was actually an uptick in spending once people got kind of the stimulus checks, once the large unemployment benefits kicked in, people wanted to spend the money. The question is, where are they spending the money? And so I think that, discussion of reopening stocks versus stay-at-home stocks. We can see the performance today of how they've played out. So to me, it's more of an allocation shift of where that money is being spent and how it's being spent, as opposed to are they spending it at all. So that's more becomes a kind of like a stock picking exercise or maybe sector picking exercise, as opposed to thinking people won't spend the money. It's more of a kind of a reallocation of how they're spending their dollars at this point in time. That's kind of what we see in the data.
And Jason, real quick, we asked an economist this last hour, and I'm curious, in your perspective, just when we see where we are at now, we obviously have a huge pullback today. A lot of that has to do with the fact that we're seeing a rise in the number of cases. So we're clearly not out of the woods or anywhere close to it when it comes to coronavirus. That, of course, leads to the fact as to whether or not we need to have more stimulus, whether it's on the fiscal side or monetary side. Where do you stand in that, and how important do you think it is in order to assure that we don't have as big of a pullback as we did back in March?
When we think about the risks that are in the market right now, obviously one is a second wave that materialized in a more significant way. Another one is perhaps almost like a potential fiscal cliff scenario, because we know that some of the stimulus that was provided, including the kind of the larger unemployment benefits, those are set to expire at the end of July. If there isn't some sort of fiscal package that materializes before the end of July, kind of before Congress goes into recess, that is a risk that we won't have enough strength in the economy to be sort of self-sustaining, where people are coming back to work. They're getting wages again that they can spend. If that's going to slow down, then there has to be some sort of fiscal impulse to support that. We've kind of seen, at least on Congress, it's a bit of an oscillation when you get better data. There's been a talk about, well, maybe we don't need as much stimulus, maybe it's dialed back. Days like today and some of the case councils suggest perhaps that's going to be an impetus for Congress to actually move forward. So I think over the next couple of days, we could hear about the size of a deal, not being, say, $1 trillion, but maybe it creeps up to like 1.5 or even 2 trillion. That's what the Democrats would want. So I think almost the worse the data gets, at least on the virus, the more likely we're to see a bigger fiscal impulse, and the market's going to like that. I think that's the key driver over the next few weeks, to see how that plays out, more so than monetary policy. Jay Powell's pretty kind of made it very clear like what he's willing to provide from the Fed. So now it's up to Congress and Washington to provide the fiscal support.
All right, Jason Draho of UBS Wealth Management, thanks so much for joining us today.
My pleasure. Thank you.
Hey, investors. Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.